everyone. Good afternoon. Hope you guys had a nice lunch. I am Jacqueline Melnick. I am the founder and CEO of Strata Media, and more importantly, I have the pleasure of being on stage today with Yuval Rooz, the co-founder and CEO of digital asset and Canton Network, and then Chris Bruner, the Chief Product Officer at Tradeweb, Kevin Kennedy, Executive VP of North American Markets at Nasdaq, and Sam Sidhu, the President and CEO of Customers Bank. I think maybe let's start with a very basic, straightforward question on the title of the panel. Is 24/7 trading actually inevitable? And what are you guys seeing in each of your respective businesses that makes you feel confident about where we're headed?
Who wants to jump in? I think it's already happening. Right? So I think the evidence we're seeing shows that there is demand for a lot of the products. And for Tradeweb, coming from being a large OTC institutional trading platform, we think that it's very important that the underlying cash markets can also have liquidity, and it's not just in the derivative markets above them. So we do actually see 24/7 trading coming. We think it's kind of table stakes, and I think there's a lot of announcements from our peers about it happening in other marketplaces. For us to see it happen successfully on weekends and off hours, a few major pieces have to happen. Like one, we think there will be a big OTC component. You're going to have a lot of specialization of protocols and how you provide liquidity in those types of marketplaces. And then I think there's a lot of components that have to come together with collateral and repo that I think we may talk about a little bit in terms of supporting like a real institutional marketplace for 3,000 institutions.
Yeah, I agree with Chris, and one thing that I will mention is we've seen crypto markets be first to 24/7 because, again, if you trade derivatives, you need to manage kind of the margin to manage the risk, and crypto markets came with stable coins, so it was very easy to companies like Hyperliquid and others say, well, we can actually manage risk 24/7. It's not just to enable price discovery, it's how do we manage the risk on the back end. I think what's even more exciting, though, is that 24/7 trading of assets is not just price discovery related. Later this month, we'll do the first transaction together with Tradeweb, where a major global corporate will actually start managing their treasury management over the weekend. So right now, you kind of go into yield products really just during trading hours, and you have some latency associated with it. But if you could actually carry some of your yield products into the weekend and just be able to liquidate it because now you can trade over the weekend, you actually get a much better return on your balance sheet. So I think we're not going to see only 24/7 usage of trading just for price discovery. I think you're also going to see a lot of other activities that can benefit from 24/7 trading.
Yeah, I would just add from our perspective at Customers Bank, we have a 24/7 liquidity pool for digital asset trading and settlement, here in the U.S. And while the markets are open 24/7, most of the activity is happening typically Monday through Friday. What you do see in the traditional capital markets is that there's a little bit of post-market closing settlement that happens post 4 o'clock. There's a bit of Asian retail, so there's a good amount of demand that will likely increase from the 10% plus or minus from where it is today, to a larger once the rails are open. But I think some of the traditional market players that participate in the digital asset industry that have a small sleeve of capital with us, like the Jane Streets, the HRTs, et cetera, of the world that represent majority of the global trading, are not banging the table demanding 24/7 trading. But I think 23/5 is probably here. Kevin can speak more to it, and likely in December with Nasdaq and New York Stock Exchange, and DTCC is already sort of tokenizing, with some pilots this summer and a full launch later this year.
So I'll go back to your original question. I thought Yuval, Sam, and Chris made great answers, but the path is inevitable. And you think about it, capital, information, and risk is there 24/7 today. But the question's going to be, it's not whether it happens, it's whether it happens the correct way, the appropriate way, which is from where I sit, just so you know what I do for a living, I oversee the traditional exchanges. So think of that as 3 Canadian exchanges, 3 Nasdaq equities exchanges, and 6 options exchanges. And there's actually, and hopefully we get to it, there may be opportunities in the short run in options as well. But the question is doing it right. It's really the exchanges, the current exchanges are the last thing that are still on a schedule. And come December 6th, we won't be on that schedule anymore. But we really want to bring not just liquidity, but the right amount of liquidity. We want to bring industrial-grade guardrails. We want to bring transparency, which you'll get with the Securities Information Processor, which is called SIP. And we want to bring the TRF along, the Trade Report Facility. So those things combined, I think, can put the institutions a lot more comfortable place to then trust, and that's a word you'll hear me say a few times today, trust the infrastructure that we're trying to build.
Before Sam mentioned 23/5, which is definitely in the play right now. We're talking about 24/7 too, but would you say that 24/7 trading is actually being demanded by institutions and retail investors, or is it being more pushed from infrastructure firms that like want to see this go forward? And if so, on the former, then like what is the overnight volume really looking like in those late hours where we're seeing traction perhaps?
Happy to jump in.
Yeah.
We've had 23/5 for 15 or 20 years now in the Treasury market. And so there is demand from institutions. And we do see that overnight. And we've spent a lot of time even trying to get to that. We still do need a window, and we're working on closing that to get to really 24/5. And then we've built a 24/7 trading system already. It's just not rolled out for our core institutional clients on the major asset classes. So I'm with you. I think we really need to make sure this works at scale, meaning you need to bring liquidity providers, and their services need to be, of the quality of the liquidity that our largest institutional clients are going to need. But to your point, like the risk is there, the geopolitical events are there, and every proof point we see, I actually don't really agree with this characterization that like everything's retail. I think, when we saw Iran crisis blow up, it was actually, we heard bank desks trading oil perpetual futures on hyperliquid, as well as a lot of other clients. So I think if you have the risk, which you do, and our clients manage many trillions of dollars, then they do need these capabilities. So the demand is kind of inherently there. I think the derivatives markets are amazing, and there's a lot of great information that comes from derivatives markets that is really valuable. And it's always interesting to me, you don't need that full institutional liquidity for it to provide the information value. But as the world keeps moving on and we get to agentic AI, you're going to need to have an open marketplace at all times and be able to move material risk. Like we're talking about the swaps market, we're talking about $1 billion of treasuries in 10 minutes, are the types of things that we're really aiming for and preparing for. And I guess the last piece there is like we're trying to figure out what are the pieces behind just liquidity. I think the collateral, the repo market, that's really what we've been trying to work on. How do you get to that? Because it doesn't happen overnight. So we've been at the digital repo piece intraday and on weekends for a little over a year now, working with Yuval and Canton, working with DTCC, working with non-bank liquidity providers that market make crypto. Because we see, like we try to build around people's real needs, and the intraday repo is building around someone's real needs to fund their crypto market making, but with a view to, well, okay, the rest of the institutional client base can use that.
Yeah, I think what Chris said is spot on, but just to put it in perspective, I mean, when you look at equity markets today, 80% of the volume is in the opening and closing auction. That doesn't mean that equity markets should be closed at noon, right? I think that, Iran is a good example of not having that capability will draw people to go to other venues. So I think liquidity profiles will be smaller over the weekend on average, but you're going to have these events that do happen over the weekend, and you do see that in treasury markets and commodities that are do open in different hours than equity markets, that now suddenly if there's an event happening in after hours, there is significant volume. Yeah. And I think that the biggest challenge is how to get the large institutional players that, for example, on treasuries have been wired to provide liquidity. I remember when I was at Citadel and DRW, there was a trading desk for the treasuries in the after hours, and everybody knew how to manage their risk in the after hours. You're just going to keep on adding more and more of these asset classes that will now be available 24/7.
Liquidity doesn't have to be as good after hours or on the weekend, as long as it has the capacity to scale up when it needs to. And I think you also can't have just a bunch of derivatives markets with no liquidity in the underlying market for too long. Right? So that's important, I think, as well. Yeah.
Is there anyone against this? Like maybe the people who don't want to monitor this or work on the weekends, but anyone else like executive level or companies that are like, no thanks, we don't want this?
I don't think at an executive level. I mean, listen, I think to some extent, I mean, are banks against moving money in real time? to some extent, you know, it was very convenient where to do a run on a bank, you had to go to the bank physically and take your money out in physical form. And it made it easier now that you have electronic money. So I think that there's always going to be this, you know, push and shove. I mean, like pull and shove. But at the end of the day, I think that when you talk to most executives, they understand that this is where it's going. So for the most part, it's not kind of, are they going to do it? It's where is it falling currently in the priority versus AI, geopolitics, interest rates. So it's happening. I think most institutional clients right now are just trying to figure out, again, like I said, if you were at one of the trading shops, they know very well how to horizontally scale costs across the organization. I think large institutions are less better at that. So they need to figure out, because the revenue, the volume profile is going to be weaker over the weekend, I can't build a vertical offering on every asset class. They'll need to figure out how to horizontally scale that capability within an organization.
Kevin, I see you speaking.
Yeah, so Jacqueline,
Please.
you know me a little bit, but my two favorite things are talking about the markets and using metaphors. And to your exact question, you know, is anyone still against this? I don't think so at the executive level. But what I'd say the metaphor I like is I think it's a bit of a stop order. I think it's institutions have been looking away and saying, okay, what, you know, 2018, 2022.
Where does it stop?
I was right to not do anything. Now it's different. It's not about It's not about Bitcoin. It's about tokenization. It's about the plumbing. It's not even just tokenization. It's about what tokenization is going to unlock. And I think we're at that point where like the stop orders are starting to get triggered.
Sam, how important is the banking layer here?
The banking layer is critical. I mean, you heard Yuval talking about sort of the changes in the banking layer that has resulted in sort of the changes from the physical run of the bank to needing sort of wire rooms that could be open. You know, we have a 24/7 network. We sort of move, you know, as a $26 billion bank, we move billions of dollars over a weekend. You know, over a year, you know, we do about $2 trillion of volume, probably up to $2.5 trillion or so this year. So we're really turning our balance sheet a lot, you know, through sort of our payments capabilities. The digital asset industry in the U.S. could not really have operated over the past couple of years without having Customers Bank and sort of the global liquidity pool and the network that we have. We have the, you know, the exchanges, the stablecoin providers, the market makers, the investors, the custodians, the banks are, you know, all sort of on the network and able to sort of do interesting things. You know, we also indirectly help, you know, collateral move, the form of the, you know, sort of proxy, you know, atomic settlement in the sense that a custodian can be moving the asset at the same time as the dollar is moving. So we are, you know, have an ability to do that. That's not sort of necessarily possible on an interbank basis, but on an intrabank basis, we can do some pretty interesting things. So I think 24/7 can move. Yuval touched on it. You know, there's the banks like sticky deposits. Sticky deposit means friction. Friction creates franchise value. And that really, and there's a lot of complexity, plus you have banks that typically don't have the tech capability to even think about how can we sort of build those rails, and how can we manage those rails. It's one thing to send a dollar or receive a dollar on a weekend, but what happens to that dollar? If it's doing the same thing as sending your Venmo to, you know, to Kevin, he doesn't actually have access to that dollar unless he's sending another Venmo onwards. It's not really that useful.
Yeah. Who ultimately gets the dollar? Maybe too, something that Chris was talking about before too on the front of repos is like one issue that keeps coming up is collateral mobility. And if institutions are going to trade 24/7, does that mean the cash and collateral also need to become 24/7? And how do we kind of think about that when it comes to things like repo markets or something else? Must. It must be.
You won't have liquidity unless post-trade.
And then people wouldn't touch it either, right?
No, I mean, again,
Or
I think take the simplest example. If you don't have collateral mobility, you can't have derivative markets. I mean, it's just if you don't have the spot market being able to move in real time, you won't have a lot of liquidity in these assets. And again, then you go into the world of credit, and then financing activity becomes critical, and that's where repo markets come into play. So all of these things feed each other. At the end of the day, you know, there has been multiple attempts in the U.S., for example, to create equity markets that were natural buyers against natural sellers, and we've seen they've never succeeded. You really need to have all of these intermediaries, all of these different instruments, all of them playing nicely with one another, and that's how you really build large-scale activity. We, for example, now are close to $500 billion of repo a day. We're already seeing that the customers are seeing the benefits. I think within the next 12 months, we're going to cross the $1 trillion a day in notional in the repo market. I think you're going to see pretty much every major platform from Tradeweb, Bloomberg, BrokerTech, Broadridge, all driving repo activity. And you're going to see that repo activity will start becoming much shorter timelines, and that will actually allow to new products, on-chain products to exist. So I just think that we're going to see within the next 2 to 3 years securities lending, repo, and a lot to do with collateral. I think that collateral mobility will be one of the best use cases for this technology.
Yeah, I think interestingly, some people ask, do you need blockchain or digital asset rails for 24/7 trading? Because in theory, you don't. You could just settle on a Monday and keep doing what we're doing, but in reality, you absolutely do. And it's because of the repo markets and because of needing programmable collateral. And it's taking a little bit of time still, but like the banking layer for cash, but then all the prime services above that, that's where the funding comes from in our marketplaces, institutionally. It's not people getting leverage on perps. It's people having billions and billions of treasuries with their prime broker that they can then repo out when they need liquidity, but they can also earn yield when they want to earn yield. And then they can apply as much leverage as they need, and the system provides them leverage. So right now, that system works pretty well, but it's not programmable at all. And so if you do want large-scale institutional trading on weekends, your prime broker is probably going to need to have your collateral be programmable and accessible.
I actually would say that it's not really working well. It's working, just to give context. I mean, there's about $40 trillion of what I would call eligible collateral that is unused in the world right now. So I mean, just think about what does that number can mean for markets if you can now have access to $40 trillion that now can be used all over the world.
Yeah, but how do you get it to be active?
Well, that's the reason why it's not active is if you're a trading firm or if you're a bank or if you're a global corporate, you need to think about your operation globally. And right now, if you know that getting one asset class from the US to Japan is taking you X amount of time, you're saying, I cannot really use this collateral in Japan right now for my trading activity in the US, even though that's where I should really use it. Because right now there's a lot of volume, there's a lot of stuff that is happening in the US. That is what we call, eligible collateral that is effectively sitting idle in a lot of jurisdictions. So right now, the estimate is that there's $40 trillion of what you would call eligible collateral that is sitting in all kinds of jurisdictions that you could actually use it elsewhere, but because of the lack of mobility of collateral, it's really sitting idle. So the idea behind doing the project with DTCC around tokenizing US Treasuries and US equities, we just recently announced with Mizuho, MUFG, and JSCC on JGBs, is really how to create this mobilization of collateral that would really allow much more trading to take place. Because now if you are a customer, you're saying, I have this balance sheet in Japan, and now I can bring it to the US to do some trading activity in the US. And when the US closes, I can move it all back to Japan to do my trading in Japan.
Mm-hmm.
No, and that's fair. If it's even worked well enough to get us to here, it absolutely isn't sufficient to get us to where we need to go.
Yeah.
I think there's a little bit of an analogy with what's happening with the energy infrastructure around AI, and that's a little bit like programmable collateral for financial markets, right? Is we need many X the demand, I think, to really have a 24/7 marketplace that works institutionally. And I think there's a massive multi-billion-dollar unlock every day and be able to use the yield, the risk efficiently. And then that will flow into these other things where you need to invest that collateral and up your trading velocities. So you're right.
Where do you all see digital cash and tokenized deposits playing a role in this? Could that ultimately be like what helps with 24/7 settlement practicality? If that's a word.
I think that I go back to the comment I made before. Like a tokenized deposit, as an example, is really just in some ways it feels like using a sledgehammer to open up a nut, right? Like at the end of the day, it's complicated. It can't be fully programmable. It requires banks to really cooperate, et cetera. Cash is digital, And we have an ability intra-bank, because that's the only solution we could really solve, to allow customers to have extreme programmability, bespoke customization, really like SaaS-like type features. The rails in the industry do need to change broadly for there to be broad adoption. Or at a minimum, there need to be sort of good last mile rails like FedNow, RTP, that allow the interbank to sort of work where the receivers also settle in real time as well, not just sort of showing up in an omnibus and pending.
Yeah, I don't see how without all the elements and last mile distribution, there's a lot of elements of what good digital cash looks like, but I just don't see how without it, this is all successful. Like I said, we're going to have this corporate that will hold a money market fund. They will liquidate it through Tradeweb into a tokenized deposit and do all of that plus FX within a matter of seconds, and then distribute it to a customer on a Saturday at 10 o'clock in the morning. So you need to have digital cash. I agree that some of the interesting things is how do you move digital cash between banks? Because again, today when you even look at stablecoin pairs, when you're actually trading a you don't even need to trade a stablecoin against a stablecoin. If you just try to move the same stablecoin across networks, the cost is pretty expensive.
It's a bit annoying. Yeah.
Well, forget about annoying, even if it was annoying, but if at least if it was cost efficient. It's not even cost efficient.
Sure.
So when you start trading a stable coin against a stable coin, it's $1 to $1, you're not even doing FX. And that is costing you, I would say, more than FX today between banks. So I think solving FX plus bank-to-bank digital cash, I think that where banks, you asked earlier, do banks have a big role to play? I think if they get their act together, they have an advantage, in my opinion, that stablecoin today, I think certain stablecoins have in jurisdictions, from a retail perspective, good distribution. But when you actually look at the developed world and even developing countries, banks have a huge advantage from a distribution perspective, which is a big part of making this thing successful. But they need to move. So, we're seeing some banks now moving faster, and we're going to see. But we're also seeing some solutions, whether it's the clearinghouse, SWIFT is now trying to do some things about bank-to-bank settlement. But I think we're going to see more and more solutions where potentially liquidity providers can actually be the bridge of liquidity across banks, and they effectively can offer both FX and liquidity across banks.
Yeah, and as messy as trading might have been before, we didn't have to worry about clients choosing what their cash leg was. So now we're preparing for a world where client A may actually want to use a bank deposit token and client B may want traditional cash or a stable coin. Can we provide that for them when they really just want to trade a treasury? But if the salary of the treasury just wants fiat dollars, but they don't want to send them fiat dollars, they want their prime broker to just move instantly their USDC, it'd be great to end up in the world where that's an easy thing to do. We're not there yet. And I think stablecoins so far have been the dominant cash leg for the on-chain activity that we've been doing on a 24/7 basis for repo. But it makes sense because it's the only thing that can move around on the weekends, and it's for crypto liquidity providers and others that want to use that funding in that world. So I think there's still juries out on how this will evolve. It's not clear to us that stablecoins will power all of or a lot of institutional trading. It could be digital bank deposit tokens. It could be a couple layers, like a wholesale layer between the banks. And then, Yuval, you mentioned the clearinghouses, right? They're integrated to Canton as well, right? So it's basically payment systems for all the institutional trading that happens behind them as well coming to digital rails. And so, again, for us, that provides a brand new problem, which is all the clients are going to want, you have to support all these different cash legs. And so we see that being a solvable problem, but it's going to take a little time. And it would be nice to see the timelines coming from the bank deposit token side in particular.
Yeah. I want to kind of get the perspective too from Yuval on the front of digital assets, been building infrastructure for many years for institutional blockchain applications. And I think maybe my question here is what have you learned about what financial institutions and banks actually need versus what the industry assumed they wanted? And then from the bank and exchange side at the end, what has been put in front of you guys where you're wow, pass. And then other things where you're wow, that's actually interesting. And maybe it has already come to market or you guys are in talks about it?
So if you were to leave it as open-ended question, what I've learned, I would say, don't do it. I
take it back.
But now that we've actually started, I think that a lot of times people think about the applications and the opportunity of blockchain, and they don't understand the reality of a bank that have been built on legacy systems for 30 plus years. Like when we did the first repo trade on a weekend, one of the banks that participated realized that they don't have the capability of booking a trade with Saturday being the trade date. The systems just were not programmed to book trades on Saturday and Sunday. So I think that what we've been trying to do is really think about how do you integrate these settlement layers in a way that disrupt the bank's way of doing business the least amount. And where you could do that, you're going to see adoption much faster. I'll give you an example. We announced a partnership with Nasdaq. They acquired a company called Calypso. Calypso does collateral management for a lot of banks. And the idea is you do an integration once into Calypso, and now you can go to a lot of the banks that are using them and say, well, now we can do collateral management without you having to really change the way you're doing your business, because now your service provider is doing that. Think about like today you could send collateral using Swift messages. Tomorrow you can do that using Canton. Nothing have changed in the core way of doing business. Similarly speaking, when we're going to announce this treasury use case, we're doing it with a very large provider of treasury management system, where they're going to say, as long as you bank with these banks that are going to be part of this network, you can now do treasury management on Canton, and here are the benefits doing it. You don't really need to change your business. And I think that it took me a long time to understand, because you're having these conversations and everybody says, yeah, I get it. Mm-hmm. And then nothing happens. And you just realize, again, how do you get into that priority list? And if doing this simple use case comes with this shopping list of everything that has to change to support it, you just get deprioritized very quickly.
So there's a lot there. I want to add on to a few things that Yuval said. And when I was just preparing for this, I thought, I really want to mention the interoperability and the ability to use a platform like Calypso. So thank you for doing that for me. And when Yuval says it takes him a long time to figure something out, that really gives me a pass. So, but I want to bring it back to just the collateral mobility in general, and what Nasdaq's trying to do outside of Calypso even, is just build this foundation of trust, and I'd call it efficient innovation and trustable innovation. And I think if we do that, what we're going to be sitting here talking about the next 2 or 3 SALT conferences is, I can't believe the things that have opened up, the collateral mobility, because meeting all the folks that I've met here just in the few days that I've been here, the energy and the innovation that comes out of each conversation, even from our lunch today, Yuval, is eye-opening. And if it's eye-opening to me, who's been in the markets for 40 years, and I know there's a lot of digital experts here, I think it will be a great convergence. Like DeFi and TradFi are not in competition anymore. This is all about building good, solid plumbing that will grow the market. And I do want to share just a little bit of data, because we talked about institutional trading, and I look at the volume data a lot. And I'll say pre-COVID, the US equities markets were trading 7 billion shares a day, 7 billion. Today, last quarter, the US equities markets had never in a quarter averaged over 19 billion. It was 18.9 not too long ago. And in Q2 of this year, it went right to 20. So as these things like Hyperliquid and others get traction, and I don't know if I'll talk about them today, but prediction markets, perps, they're also complementary if we build the right plumbing. And I think what we'll learn 2, 3, 4 years from now, and I think it continues to accelerate, is the market's going to grow exponentially. It wouldn't surprise me, and I know we're not making predictions, but 30, 40 billion shares a day in equities is very easily attainable.
All right, you brought up perps, so we'll talk about them. It's a very hot topic. Everyone, I feel like, is obsessed with perpetual futures right now. How do you guys think about that fitting into the 24/7 trading market? And is the demand actually matching what the public perception is currently?
I can just finish my thought and then open it up to others. When I think about perpetual futures, I think, again, like I just said, I think they're very complementary because they're a derivative product, and options back in the 70s when they started in Chicago, they've been nothing but additive to overall volume, and they've been nothing but additive to liquidity. You get a better market if there are derivatives. You get more hedging, you get more interaction. And when it comes to perpetual futures, I just think if investors want either one of two things. They want true ownership, and they want a voting right, and they want every corporate action, or they want exposure. And they both work. Like, exposure is good. And the more that investors want exposure, the more the liquidity providers provide that exposure and then spin their liquidity around the entire globe at a time when we see the global demand because of all the things we talked about earlier.
Do you guys feel like the investor exposure today is where it should be, or is it still limited and the distribution is more to maybe accredited investors, institutions, and so on that can't really tap into maybe the retail audience?
Well, I think perps have been a really interesting proof point to show that there is demand for all the products you can offer them if you can give them the right product and they can trade it and it's got liquidity, right? So some of these things were only available to large institutions or hedge funds or advanced strategies. So it's interesting to see retail pick up most of the perps that are coming, right? And that crypto innovation is definitely channeling over into a lot of our asset classes. And so for us, we see it as like one extra tool in the toolbox. And the whole cannibalization argument hasn't really played out. It was cash markets, it was futures markets, it's options markets. Now you've got perps. They are mostly retail so far, so we're not like worried or believers that our institutional clients are going to migrate too quickly to just perps, because there's, especially in fixed income, there's so much complexity and sophistication and duration management and a lot of other pieces. So for us, we do a ton of basis trading between cash markets and futures markets and derivatives markets. Having one more variable just gives you one more opportunity. And so we do see there being demand, because there might be a lot of people that want exposure to our markets, but they don't want to invest in like sophisticated hedge fund style strategies. But if they get a really pure way to invest in 10-year treasury duration with a certain amount of leverage, and there's liquidity in that product, it doesn't have to remain just a retail product. I think if we get the collateral mobility, if we get repo markets, we get a few of these other precursors, you can see some institutional trading in these products as well. We think including prediction markets.
Yeah, I think that perps have just shown that they give a very good user experience to get leverage exposure to a very simple outcome, right? At the end of the day, options give you much more variables to have a very controlled kind of like outcome that you're trying to aim for. And as a result of that, you need to learn Greeks and you need to learn, option pricing, and it's very complicated. So I don't think that we're seeing options going anywhere, because again, institutions will want that level of sophistication. But I also think that when people will want to say, I want to take a bet on the 30-year duration with leverage, and that's a very simple kind of outcome that you want, well, it would be much easier to achieve it with a perp than with an option. And therefore, as long as the option is, the perp is priced fairly, you would use a perp. And I just think that, as Chris says, it's just another tool that is going to be added, and I think that you're going to see institutional adoption there as well.
Yeah, and like you said, price fairly. Jury's still out with some of the RWA perps, right? So you will not see a lot of success institutionally with RWA perps if the funding rates are 10 to 12%. It just won't be. It has to be much closer to arbable with, now, but you will see active arbitrage from sophisticated players to help get it to institutional rates if it's a product that clients want to trade.
Is there limitations to this in terms of like what's actually possible of using it and the existing
I wouldn't say that there's
frameworks?
inherently a limitation. I think that currently perps, for example, because again, it's retail, and I think that that's part of the reason why they're not as capital efficient. Perps don't allow you, for example, to pledge the underlying as collateral, right? And if you were to allow institutions that want to go short the perp, long the asset class, and then pledge the actual underlying asset class as the collateral, well, that would make it so much more capital efficient to trade these things, which you would expect, again, the cost of funding these things to go down and make them even more attractive. So I don't think that there's an inherent limitation, but I think that there are still many more things that you could do to make these assets more efficient.
I want to ask you guys also about AI, another hot topic. Everyone wants to talk about it. We're increasingly hearing that AI agents are participating in financial markets and potentially managing liquidity, settlement, other processes, et cetera. Do you find that AI makes that 24/7 market more feasible, or does it now create more risks and headaches that we did not have prior?
Both.
Amazing. It's a great question, right?
Yeah. I mean, both. I mean,
So
yes.
it's worth it, but we're going to have
No,
things to iron out.
you're definitely going to have things that trade on your behalf.
Right.
I mean, I did algo trading. I mean, we traded algorithmically. I mean, we didn't call it agents, but
Right.
we had
Yeah.
algos and servers and risk limits that were trading all the time without having a trader actually.
They just
you
gave
know,
it a cooler
clicking
name
everything.
now. Yeah.
No. I mean, it's a good name, and at the end of the day, it is definitely going to be a big part of the volume that is going to happen during after hours, and at the same time, you will need to have better risk monitoring tools to keep track of them, not just because of the after hours, also during hours. No different how, for those that remember, Knight Capital went down because they didn't have good risk controls when they uploaded the wrong algo. And that empire fell down in 40 minutes for having a bad algo in there. So you could have also a bad agent, not just during the after hours, also during hours. And as a result of that, you will have to build better risk systems and be able to have the tools to manage these systems.
To your earlier question, there are lots of traders who actually don't want weekend trading. And that's true in the rates market like
That's where their
treasuries.
agents can
It's
come in.
absolutely true in corporates and munis and some of these other less liquid marketplaces. So at a minimum, we hope AI can, we use the phrase, let's not make Saturday the new Monday, you know, that you're going to need it for all these ancillary services. So people can be on call, you can have humans in the loop, but you definitely need it, and it's already being deployed. I agree with Yuval. For us, automated trading, we have marketplaces where 80% of our tickets or more are going through some form of automated trading already. And the sizes these systems can handle are up to 10, 20 million notional in some cases, or more if it's front-end type trading. So this is just another extension of let's move to agent trading too, but you need guardrails, regulation, a lot of pieces of the system.
Yeah, I think AI is going to bring, I think it's happening at a great time for overnight trading. I think it's going to bring responsiveness, efficiency, and intelligence. But at the end of the day, and I'll save a minute for Sam, at the end of the day, the human's going to be accountable. So AI is not going to replace the accountability, but it will increase the efficiency and lower the operational spend.
Yeah, I mean, I would just add that I'll make the comment I made earlier about the rails. I mean, the rails are the most important. You need the rails to be able to have the AI on top of it. You know, as you've all said. I mean, there's a lot of automated trading that's happening today. Most of the trading is actually automated already, and you know, I think that one of the things that's going to be important, if you sort of think about it from a bank perspective, is 24/7 trading at 2 in the morning. Our treasury team is not sitting around managing our liquidity, right? It's easy to say, you know, 11:59 and 12 are sort of the changes in sort of your balance sheet. But that kind of becomes a little bit irrelevant at some point in time, and you have to sort of think about how you manage the bank, and goes back to the earlier comment I made about friction and deposit franchise and management of liquidity. And there's going to be a big evolution, the change in banks over time as they have to sort of think about, especially the money that moves will need to be treated very differently than the money that is used sort of working capital operating accounts.
Well, a lot to keep in mind here. Yuval, Chris, Kevin, and Sam, thank you for taking the time, and thank you to everyone for listening in.
Thank you.